right, good afternoon. So I'm Jennifer Troyer. I'm Dean of the Belk College of Business at UNC Charlotte, and I am so delighted to welcome all of you to the North Carolina Economic Forecast in person for the first time since March 2020. It's always so wonderful to connect with our alumni and with the business community and our students in person as well as online. So thank you to our sponsor, LPL Financial. Over the years, we've been thankful to our friends in the business community like LPL Financial for providing essential funding for this event and the research that underlies the presentation. So I'd like to welcome Mark Zabicki, Chief Investment Officer for LPL Financial, for a special word from our sponsor.
Good afternoon. I want to thank Dean Troyer for the opportunity to collaborate with UNC Charlotte this year, and we hope it's the first step in many in terms of collaboration and opportunity to participate with this great university. LPL Financial is certainly glad to be here, proud to be a sponsor of the 2023 Economic Forecast Series. And we hope you enjoy.
All right, thank you, Mark. So LPL Financial's generous support is a really stellar example of how Charlotte's business community helps us to fulfill our mission to serve the community as North Carolina's urban research business school. So if this is your first economic forecast, any show of hands? Anybody for their first economic? All right, welcome. If you haven't visited us before, this is the Dubois Center. So this is the UNC Charlotte Center City campus, and it is the home base for all of our graduate programs in the Belk College. We offer a variety of part-time programs for working professionals and executives, including our nationally ranked professional MBA program, and as of August, our new online MBA featuring concentrations in business analytics and digital marketing. For those of you on Twitter, you can join today's conversation about the economy using hashtag NCForecast, and we look forward to seeing your tweets. Today's forecast will have a unique format featuring a short presentation from each of our two highly regarded economists, followed by a panel discussion and then time for your questions. So questions from both our live audience and our virtual audience. So if you're joining us via Zoom, you can submit your questions via chat at any time. And now, it is my pleasure to introduce my colleague, Dr. John Connaughton, Professor of Economics in the Belk College. So for over 40 years, John has been interpreting the data and sharing his expertise around where North Carolina's economy has been and where it's going next. So please join me in welcoming Dr. Connaughton.
Thank you, and it's really good to see you. Okay. I remember, I don't have time to do this, but I'm going to do it anyway. I remember back 3 years ago, Wednesday, March 11th, this place was full of people, and on Friday, March 13th, we all went home. And so it's really good to see us back together again. But I get ahead of myself here. So what we're going to talk about today is we're going to review 2022. We're going to take the outlook for 23. We're going to talk a little bit about inflation. And then we're also going to take a look at basically whether or not there's going to be a recession this year. And I got to start real fast. So let's take a look at the economy. This has been, the U.S. economy was down the first 2 quarters negative. We only had 1 quarter that was down. A lot of people thought it was a recession because, we had 2 quarters down. That's just a rule of thumb. It's not actually the definition of recession. It's a decline in overall economic activity. We did not achieve that. Labor market was very strong. There were some idiosyncrasies as a result of supply chain issues and as well as inflation, which created some productivity situation that caused real GDP to be down. Nominal GDP was up substantially during that period of time. In terms of the sectors, and for those of you that are here for the first time, quickly do this chart. The horizontal axis is the growth. So when you look over here, it's the growth of these sectors in terms of output. And the vertical axis here is like a pie chart. You add all these up, they should add to about 100 or maybe 99.9. with rounding. And so when we look at these, the size of these rectangles tell us how much on a weighted basis, each sector contributed to overall growth. And as you can see, we had a lot of sectors this past year that were negative, and particularly manufacturing and construction, we had some negative activity during the year. Overall, GDP grew by 3.7%, but that's because of what happened at the very end of 21 with some really strong fourth quarter growth. Looking at job sector was a phenomenon, despite GDP being kind of sluggish that last year. Jobs were off the chart, basically. We created 190,300 net jobs, December 21 to December 22. It's the biggest number since I've been doing this. It's just, normally a good year is 100,000 jobs in North Carolina. This is double that, so it's really quite surprising. And as you can see, even sectors that had negative output increased jobs during the year. Big one, obviously, hospitality and leisure services, but also business and professional services were also big job growth sectors. Looking at 2023, we expect it to be actually pretty good. A slow growth rate, but it's going to pick up over the course of the year. First couple of quarters will be a little sluggish, but by the end of the year in the second half. Now, as everybody in here knows, a lot happened over the weekend, okay? And Dr. Jeffrey and I will be talking about that in the question and answer period, all right? But I still stand by, I'm not sure at this point in time that we're in for a recession this year. Slowdown, yes, 1.2% growth, it's going to be sluggish. One of those quarters may not turn out to be a growth quarter, but my guess right now is the economy is still strong enough, the labor market is still strong enough that I don't really see a recession coming forward. I'm getting ahead of myself because I got a whole section on that. In terms of GDP, again, only manufacturing and construction is really going to be negative next year. Most of the rest of the sectors will experience growth. I'm going through these pretty quick, just so everybody knows these will be available that you can go ahead and look at later, okay? So it's all right. And on the employment side of things, we're going to have 74,300 net jobs. That's the forecast for 23. That's an average year. That's a good year. Not great, but it's a good year. So the labor market is likely to be continuing to be strong during 2023, as it has been for the last couple of years. All right, unemployment rate, we got to see it rise up a little bit through the year. Right now, we're sitting at about 3.99%. We'll dip down a little during the year, but by the end of the year, we'll probably end up at about 3.9%. Again, strong labor market, U.S. and in North Carolina. All right, so inflation, that's why everybody came here. I'm doing good, all right. All right, so this is kind of the year-over-year monthly inflation rate, starting back in 2020, and then we saw it really increase in 21. Last summer, we had the peak of 9.1% annual rate of inflation. And as you can see, for the past several months, there's been a consistent decline in the inflation rate year over year. So that's the 12-month. So, for example, the one that was just recently released last 2 days ago, that was February of 23 compared to February of 22, and prices were 6% higher over that year. All right, but it gets a little bit more confusing because when we see what's going on with interest rates, we know the Fed has been increasing interest rates over the past almost a year now. But what I want everybody to be reminded of is the period from the 70s where we were basically, the red is the CPI, Consumer Price Index. The blue is the Fed's interest rate, the federal funds rate. And as you can see during this, the Fed kept tracing inflation. So as soon as inflation would show a little bit of turn, the Fed would start to reduce the rate, and then, that would work for a while and then back up again. They never really, until they got above and started to have what we call real interest rates, where the interest rate is considerably above and creates a 2 or 3% real interest rate, to where they finally got inflation under control and consistently were able to drop it down below, in this case, 5% in the early 80s. It's kind of a reminder of where we are right now in terms of what's been taking place, because here's what we've been doing. We ignored inflation when it started in 21. We just kind of ignored it. So what happened is we kept the rates low until we started to see some incredibly large increases in the CPI. And, we're starting to do this. They're starting to come together. but we haven't seen a real rate yet, and that's something we need to think about going forward, all right? We're making progress on inflation, but we've got a long way to go. So Jeff and I will talk about that in terms of what we expect the Fed to do in a bit, but it's still not done. By the way, since this all started, since we got CPIs above 2% annual price increases, which is kind of the cap that the Fed looks at as what their target is, we have seen prices go up by almost 16%. So, you know, when you go back here and you look at this thing and it's falling, you say, oh, that's good, right? But prices are still increasing. And over the course of this, we've seen prices go up by 16%, wages go up by 12%. You can do the math. You're 4% worse off in terms of your purchasing power in the last year and a half. So that's a serious issue. All right, so fighting the Fed. The problem we're having right now is the Fed is trying on the demand side to reduce demand and slow the economy, but we got consumers that are fighting the Fed. They quickly went through all of their savings that they developed over being shut down for a while in 20, and then all of the checks that came. They burned through those. They're now burning through their credit cards. They're fighting the Fed. They're saying, okay, I get it, inflation, right, but I'm going to have these experiences. The stock market's fighting the Fed. They keep thinking the Fed's going to turn sooner than creating real interest rates. So the terminal rate has always been just a tad over 5%. Today, it's right about 5% in terms of the expectation of the terminal rate that the Fed is going to generate. And so they're fighting the Fed as well. Congress and the president are fighting the Fed with deficit spending. There's no way around it. It's extra demand in a period of time when the Fed is trying to curb demand. And then finally, what happened on Sunday evening with the lending facility for banks could potentially wind up being another round of quantitative easing like we saw coming out of the 2008-2009 recession. All right, if this goes ahead, let's take a look real quick. So here's, this is the good news, all right? Over time, recessions have gotten a lot shorter. Okay, and expansions have gotten a lot longer. So if we have a recession, it's likely to be a short one. All right, so that's the good news. Here's the Fed policy in terms of their interest rates and basis points, in terms of the last 8 increases in interest rates. And of course, the big question is what happens next Wednesday? What are they going to do? But you can see and a lot of folks have complained about the 75 basis point increases here for 4 meetings in a row, potentially causing problems with the term structure of banks between their debt and their deposits. The current target rate for the federal funds rate is 4.5 to 4.75. So we still haven't reached that 5% that even the stock market thinks is the terminal rate. My guess is it's actually going to go higher than that. They meet again next week on Tuesday and Wednesday. We'll see what they do. And then again in May, and that's going to be an important one as well, because if they're going to create real interest rates, even with inflation coming down, they still have got to create a real interest rate to convince folks that they're serious about fighting inflation. So it'll be interesting to see in the next 2 meetings what they do. And the expected March rate is 25 basis points. Jeff and I can argue about that later this afternoon, but I think that's pretty much where we're looking right now. And if this goes ahead, all right, so recession uncertainty and economic headwinds. We've got these things that are basically things that we need to concern ourselves with: consumer confidence. What has cropped up recently in the past week was banking sector uncertainty, whether the Fed will be consistent and continue to be hawkish and fight inflation. Wage catch-up, we still are 4% behind, so even as the Fed fights and brings demand down, wage pressure in a tight labor market is going to keep pushing wages up, and that in and of itself is also potentially inflationary. Continued supply chain issues, they don't seem to be going away. I'll tell you a story about that later. And household saving levels are being depleted, but consumers are very, very happy to continue and save, as we like to say, and use their credit cards to continue to have experiences. And finally, you know, at these wild cards that are out there, deficit spending, we don't know what's going to happen with the federal debt ceiling going forward and the kind of impact that could have later in the second quarter. All right, so that's it for me. All right, these are things that takeaways, exogenous shocks. We saw one last week. with the banking sector. Fed policy matters, they're resolved. Demand side versus supply side inflation and what we've got going on now. The wealth effect and the impact that has as the stock market corrects, people become less wealthy, their 401ks go down, they get nervous. You've all been there, right? Don't open your 401ks this month, okay? Do not open the statement. Trust me, okay? All right, and then finally, 50-50 chance of recession in 2023. That's it. Jeff, you get the slide, you get the clicker. Thanks.
Sure.
Okay. I'm just going to introduce Jeff. Oh, no, that's okay. I just want to introduce him for those of you who don't know Jeff. So thanks, John. So Jeffrey Roach is the Senior Vice President and Chief Economist for LPL Financial. He serves as a voting member of the Strategic and Tactical Asset Allocation Committee for LPL Financial, where his ability to relate economic conditions to financial market outcomes is highly valued. So he has some broad experience on an institutional trading floor and in portfolio management, and he has presented economic research as far away as Italy's Ministry of Finance in Rome and the Office of National Statistics in the UK. So welcome, Dr. Jeffrey Roach.
Thanks, Jennifer. Thanks. Yeah. Well, excellent. So let me start with a story. The year 1947, the place Buffalo, New York, a place blessed with the lake effect. And by the way, if you don't know what lake effect is, count your blessings. But Buffalo is also blessed by having my grandmother work as a seamstress. 1947 was interesting, though. She had pivoted in previous years from making curtains, if you will, moving to cots, right? It was all about, as we thought about those World War II periods, it was this massive pivot. Cadillac was no longer making engines. They were making the M5 Stuart, a light tank that went all over Europe. 1947 was an important year because we were seeing as an economy moving out of this wartime construction to post-wartime construction. We actually had 2 consecutive quarters of negative growth. John just talked about the idea that, back of the envelope, napkin kind of style, well, sure, 2 consecutive quarters. Recession, not so fast. It's actually happened before. 1947 was the last time. Granted, that's a long time ago. But I think the bottom line, if you want to take anything away from this portion, we're going to have a nice Q&A, so we're going fast now, but don't worry. The post-World War II economy informs us about how we should think about the post-pandemic economy. That's an important takeaway. I'm not going to unpack it because it's already 19 minutes after the hour. Think about that, though. Post-World War II, post-pandemic. That explains a lot of the flux. All right, so that being said, it's a world out of balance. That's the title. So I'm going to talk a little bit about consumer spending and rents. Get a little bit deeper on what we're seeing in terms of the housing market. And of course, inflation. Won't reiterate everything John just said, just maybe a little bit of alternative ideas to think about with the inflation story. And then layoffs, I think, is a great idea to think about, again, in terms of this flux, this post-pandemic flux. Think about layoffs. So right off the bat, I'll just remind folks, yes, we will have these parts of the slides available. However, UNCC would like to do that. But you also have a smartphone, so if you just want to start clicking away, I'm going to go fast. During Q&A, we'll be able to get a little bit deeper, but feel free to take pictures of these things here. So what about consumers? Here's what's fascinating to me. If you can just look through this slide, pre-pandemic, you kind of had a 70-30 ratio between consumer spending on services. I loved how John said it. People want to buy experiences. And then this spending on goods. We all know what happened when we were working from home. We all started going to our Amazon apps, and we're like, hey, yeah, I'll take one of these. Oh, I'll take maybe 7 of these. Oh, toilet paper, maybe 25 of those, right? This rotation and very quick rotation from a more normal ratio between services and goods was completely torqued. We're not quite back to quote unquote normal yet. I think that's very interesting to just think about. And again, you can kind of go drill into this. We blog on this, lplresearch.com is our blog for those that are interested. But we still have that frustrating torque in the economy and how consumers are spending their goods. Clearly, that I think has implications for inflation on the services side, right? Everybody wants to go to Grand Tetons. Everybody wants to do these travel experiences. Hence, we think there's still a little more of that pent-up demand as consumers kind of find their balance between goods, services, and spending. All right, services and experiences, if you will. Businesses seeking balance. This is an interesting story. When you think about the residential side, everybody knows, nothing new here in terms of where the risks are on the residential side. We got some data earlier today and yesterday on permits and housing starts. Month to month, there's these quick movements around, but in essence, you still have a lot of downside on the residential side, single family, but what you can see in the construction data, that there's a completely different story in the multifamily units. Here's something that'll blow your minds here. This is just construction spending. This is a very much a leading indicator on what we expect in terms of projects coming online and what things will be looking like, say, a quarter or two or three from now. But if you look just at construction spending, take out some of the volatility month to month. This is 6-month change in spending between single family and multifamily. You don't have to be too smart to realize that there's, I think, a pipeline of projects in the works for multifamily that'll help on the rent side of the equation. So when we think about inflation, right, there's all kinds of things. There's used cars. We talked about that, for many months, say a month ago, a year ago or more. The rent story filters into the shelter cost. That's the services side. But look at that. That's amazing in terms of the amount of construction spending. Right now, we're talking January 2023 is the latest data. So this is fresh data and very much a leading indicator on that. So what about the Fed seeking balance? I want to tell just a quick reminder. I think it's a perfect analogy of where we need to think about where the Fed's going to debate things next week. Go back to October last year. Remember the announcement in the UK. They were going to have all these unfunded tax cuts. Remember, things went crazy within the gilts market, the UK government bond market. Guess what the Bank of England did right around that time? They did two things. They addressed price stability and raised rates. They also addressed financial market instability, right? Inflation, raising rates, financial instability, provide extra liquidity in these funding facilities, kind of a QE, if you will, to tag along to what John said earlier. So the Fed could very much do what the Bank of England did last year. Interesting, just within the last 48 hours, 24 hours, the European Central Bank did something very similar. Raised rates because of the inflation problem, but provided this backstop to say, okay, don't get nervous. So I think that's going to be a scenario. Another thing that I want to kind of remind folks is the Fed often breaks things, puts the economy in recession, and that is the strongest and most powerful cure for the inflation story. But not always. You can see in the 90s, this is what I'm showing here, in the 90s, you had really what was happening was growth overheating. That's the blue line. Right? Growth overheating. The Fed responded by raising rates and then kind of backed off. Now, granted, one difference between the mid-90s and now is inflation was a lot tamer. You look at that gray line in the 90s. But I think it's indicative, again, during Q&A, we can talk more about this in terms of what the Fed's trying to do in finding that balance. So I want to leave you this, though. We think inflation's going to be in the 3s by the end of the year. Now, that was going to definitely help calm the markets, right? Because the markets look at these percentages, year-on-year changes. But remember, inflation is still rising, John, as you pointed out. Prices are still going up. just at a slower rate. But in terms of how the markets are going to respond, that's going to be a net positive for markets. You're still going to feel it in your wallets. But that's our forecast. I think that's very important to think about how quickly inflation will actually turn when we find ourselves in December. One of those things being the rent story. All right, so job market. And then I think I have one more slide, and then we'll think we're close to on time, maybe about a minute over here. Remember I told you about my grandmother, Buffalo, no longer making curtains, doing cots, toys to tanks, board games to machine guns, however you want to think about this movement to wartime and now post-war time. What's fascinating right now, and this is somewhat of a warning sign, you can't sugarcoat this too much, but when you look at why firms are laying off people, for the vast majority of time this past year, it's been about cost cutting. That's the orange. We actually know this because we have excellent data on finding the reasons on why there are layoffs in firms. Last month, there's been a switch for the first time in a long time. The reason why firms are cutting people on payroll is because of the demand downturn. That's the blue bar there. So that's a little more worrisome. I think it does argue for the recession story in 2023. That's our base case. I think it's going to be less than the post-war average. Post-war average is 10 months of a recession. We think it's probably going to be a little bit shorter given the stability in the consumer side of things. All right, so here we go. I'll leave it. This is my last slide, and then we'll start some Q&A. So what in the world is happening? We'll talk about it in Q&A. We think this chart here illustrates why the thesis that this is not a great financial crisis kind of scenario. So what I did was I literally just took yields on the 4-week T-bill. I said, okay, how fast is this moving around? What's the volatility in yields? Just a week over week change. You can see it's been pretty nasty. It hasn't been this bad since COVID. But again, be a student of history. That's what I tell my kids all the time. Know your history. It's so important. There's a great financial crisis in the 07 or 08 era. Clearly, this is very different than what we saw with the Lehman moment. So with that, I think we'll close it down. Oh, I'll read my disclosures. No, I won't. Love to take questions and have a good discussion. So.
I think I'm at the end. I'm at the end.
Okay.
That's what they told me to
So
say.
thank you, Jeffrey.
They told me to sit here.
So we are now moving to the panel discussion with both of the economists. Please continue to think of your questions to ask the panelists during the Q&A period. And then those joining us via Zoom can still submit your questions in the chat anytime. All right. So I guess I need to join you guys here. Let's see.
They put a chair up there for you, Jennifer.
Yes. I get to sit. Okay. Wonderful. All right. So, John, I'm going to start with you. So what are your thoughts? So I think you mentioned this in your talk, but maybe you can just reiterate. What are your thoughts on the likelihood of a recession this year?
Okay, before last Friday, okay, I was sort of 50-50. A lot happened over the weekend from last Friday. I'm not sure it's changed a whole lot. I just want to go on record as saying that I think that the serious real adult in the room, Jerome Powell, stood up on Sunday and made the right call in terms of basically saying we're going to cover everything, no matter how much. We're going to cover the depositors at banks. We're not going to say banks, but we're going to cover the depositors at banks. And I think that made Monday a much more relaxed day for most of us. And I think that depending on what happens over the next, say, month, and if everything turns out that we really don't have another major financial meltdown, I think that we're looking pretty much at the same situation that we were looking at last Wednesday. And that is about a 50-50 chance that the Fed will push a little too hard and potentially, anyway, make the lending a little harder than we were expecting.
Jeffrey, your thoughts?
Yeah, I think the only thing I would add to that is, most of the time a recession happens when there's fundamental flaws in in the broader banking sector. I think everything goes down to what are the risks of contagion and what actually happens. Is this something that actually truly spreads through the whole system? Then, no question, recession's happening. The reason why I think we're at this 50-50 coin flip is because you have certain indicators that are saying, recession's imminent within 6 months. Leading indicators from Conference Board, inverted yield curve. But we're having, phenomenal activity on spending, starting to slow down, but a job market that's pretty solid. So that's why there's the little bit of this 50-50.
Got it. So let's just suppose that we do have a recession. We end up on that side of the 50-50. So any thoughts on how severe it'll be, how it'll, what the peak unemployment rate might be? Let's start with you, Jeffrey.
Yeah, so I think it's, as I hinted earlier, it's going to be shorter than your post-war. So, for those that are really wanting to geek out on this, you go to the National Bureau of Economic Research, gives you all the peaks and troughs and the cycles. It actually, by the way, I tell people this all the time, it gives you the official definition of a recession, which is a significant decline that's broad-based, has to be across many sectors of the economy that lasts for more than a few months. And that's why we haven't seen those necessary ingredients quite yet as of to date. So I think the unemployment rate is probably not going to tick up materially given the slack or the tightness, given the ability, I think, in terms of the ease in which individuals can move from job to job. Remember, to be counted as unemployed, you have to be looking for work for a period of time. Well, in this kind of environment, you do the quiet quitting or you do a side hustle, right? The BBC just did a great story called the Gen Z side hustle. It's a great story, and it kind of illustrates the way that the labor market, in essence, has a little bit of that fluidity. And I think will, in essence, if the recession happens, unemployment rate won't rise as what in normal times.
Got it. John, what do you think?
Well, I think Jeff's right. I think that if we do have a recession, again, let me back up for a second. All bets are off if we have contagion. So let's be clear about that. We had that exogenous shock, but as I said on Sunday, Powell came forward and did the right thing, all right? That's not what happened in 2008. They let Lehman go, and they didn't say anything. Now, again, Lehman was an investment bank, not a commercial bank. There were not deposits. But the contagion that happened was, these are bad assets that they have, okay, bad loans. And as a result of that, other commercial banks could have it. And in this town, we knew what happened because we saw what happened to Wachovia as a result. They were the next bank in line. Washington Mutual and Wachovia were next. But for contagion, we're going to have, if we have a recession, it will be mild. And what's interesting is, how mild will it be? Well, first of all, what Jeff was saying about the NBER, there's 6 actual things they look at. GDP is just one of them. The other 5 are diverse throughout the economy. A couple of more labor market indicators. We probably won't have a peak unemployment rate much more than 5% in this if we have a recession. And that's going to be really different because the last time we had a recession, the unemployment rate got up to 10%. And so it's saying, well, how are you going to have a recession with 5% unemployment? But labor markets are so tight, that 5% will be a significant increase in the unemployment rate. But I think that's probably the peak that we're looking at, except if there is a second round of financial problems and banks stop doing what it is they're doing, okay? We've already seen banks start to credit tighten. And we've seen that just this week. And as a result of that, again, what do banks do when they fear a run? Cash is king. It's the saying in the industry. Everybody wants to make sure they have enough cash so if people show up on their doorstep on Monday morning, they don't have to lock the doors at 10 o'clock. All right? Now, no, seriously, Powell said, that he's going to back them. We'll see. They took care of SVB and they took care of Signature Bank. And everybody's working really, really, really hard on Credit Suisse. So we'll see what happens.
Yeah, let me just add one additional thing. Again, to kind of compare and contrast between now and what it was like in 07, 08. Yeah, I was coming out of graduate school. 04, my first job out of grad school was working on the Bank of America trading floor. One of my first projects was, hey, Jeff, can you go research this new product called collateralized debt obligations? You can't make this up. So that kind of scenario, those kind of environments, those products aren't the same. 2023 is nothing like where we were, 04 and 05. So again, kind of know your history, know the context, put it in context. I think it's very helpful.
Yeah, got it. All right, John, so you said the Fed is likely to raise interest rates 0.25.
Yeah, 25 basis points.
Do you think anything changed over the weekend? Do you think they're still
there's always a
likely to do
betting
that?
market on what the Fed's going to do.
Well,
all right?
sure, yeah.
So last Wednesday, the betting was 50-50 roughly, 25 basis points, 50 basis points. Because we had a really, January and February job market numbers were seriously strong. Okay, really big numbers. I mean, the January number, when you extrapolate that over a year, is what, 5 million jobs?
Mm-hmm.
And the February number was not a whole lot better. That's almost 3 million jobs, and if you extrapolate that over a year. Those are big numbers even for the U.S. economy at this point in time. So we had a really strong job market, and so the betting started was around 50-50. Powell made some statements that suggest, maybe we go back at this thing a little harder. If you look at it today, it's 50-50, 0 and 25. Okay. My concern, what I'm hoping the Fed does is 25. And I'll tell you why I hope they do that. I think that if they were to do 0, it would send a less than confident signal about how they feel about the banking sector. And I think that 25 is not going to hurt the mismatch between the term structure of deposits and the term structure of their debt for any bank in this country. I don't think 25 basis points makes that difference, but it does say, hey, that happened last week. We're fine going forward. We're still fighting inflation, and it's in line with what we did last meeting, and it's probably in line with what we're going to do in May.
Your thoughts, Jeff?
Yeah, and the Fed does have the ability to say, hey, we got 2 issues, and we can address both of them, inflation and financial instability. I think that is an interesting point to think. The markets will interpret a no change as the Fed thinks contagion is a pretty high risk. I think that's what, that's why I think in terms of, that kind of two-handed approach. Here we're doing this to address the instability issue, but here we have to do something about the inflation story.
So, Jeffrey, let me ask you first. So, how is the fight against inflation going? I mean, does the Fed need to do more? I think, John just sort of said what he wants them to do this time, but do they need to do more?
Yeah, so how is it going? Not very well. So that's the short answer. The long answer is that, you see, I think the Fed has done the right thing to say, hey, let's just be aggressive because we were behind the curve. Let's be aggressive. Now, we don't know what the lagged effects are of tightening, so let's start slowing the pace a little bit. So I think, they do have more work to do. But the challenge is when you think about the consumer still wanting their experiences. I think to maybe take a little bit of another angle, you could say, well, perhaps, again, all of the households, 65% of households own their home. They're not renters. So in order to capture housing costs and housing inflation, the government has this thing called owner's equivalent rent. So I have a fixed rate mortgage, it's 2.5%. Okay, what's the equivalent rent I would pay? I'll tell you this, it's a lot more than what I'm paying on my mortgage. But that's a funny number, OER, it's an imputed number. So again, going back to, okay, the Fed has some more work to do. It's possible to say that part of that work may have already been done, and we'll start seeing it in earnest when some of the rents turn over. But at this point, yeah, the Fed does have some more work to do, and it's been a challenge for them to try to rein in and kind of get to that pre-pandemic world. Maybe we'll never get there again.
I'll believe it when I see the price of eggs come down.
John, did you want to add anything?
No,
else?
no,
Yeah,
I think
yeah,
that's
it's
right. I
just the
think
eggs.
that
All right.
it's too early right now for us to really tell how effective. We have to remember they were late coming to the game, 6 to 9 months late. We all know that. We all accept it. And that means they have to fight harder. And it makes it more difficult for a soft landing. When Jeff had a slide up there in terms of how quick they were in the mid-90s to come in, and most of us didn't even know it happened.
Right.
And they were, but when you're late, it's more difficult.
Yeah, yeah, got it. So we are going to shift to the audience questions now. So thank you. So as a reminder, you can still, if you're online, submit the questions via Zoom through the chat feature, and our staff are going to provide a microphone for those of you who are here in person. And what I'm going to do is sort of rotate back and forth between an audience question and an online question. So let's start with the in-person folks. If you could raise your hand high, and we've got folks on the side that'll bring some microphones. Okay.
Thank you. First, thank you for your time being here. Secondly, regarding the Credit Suisse debacle that happened over the weekend, and the facts that some of the issues were because of them going into their internals, do you think that it might be less of a risk of contagion and possibly more of a inoculation for other, financial parts of the industry?
So, there's always a need to drill deeper, right, in terms of, what are the reporting statements saying. By the way, you can still go and see the Basel III statements on SVB and read through that. I think, we know the market views the Swiss as, the stable, boring people that are always going to be there for you to help you out, right? And I think, in essence, it's possible to say that the fact that we've started this big conversation of, hey, maybe we haven't seen banks hedge interest rate risks like they should have. It clearly is a potential that larger banks have done the same thing. Now, I think it's very fair to say when you look at the details that the two banks, if you want to just take SVB and Credit Suisse, very different terms of customer base. Right, so who are holding the deposits? I mean, this is a very much a tech-focused bank. If you're talking about SVB, Credit Suisse clearly a lot more diversified. So that's one point that I think is apples and oranges in that sense. And I think the second is we do know from a fact, and even looking at previous times when interest rates rose quickly, again, great financial crisis, we know that Credit Suisse has greater skill. They've done it better in the past. So they're a little more believable in when they talk about their interest rate hedging. I think that's two things I think it's helpful to think about in that issue.
And one other thing about the Credit Suisse situation, they've been in trouble for 6 months. This is not something that cropped up. It just got pushed higher up above the fold on the page because of what happened at SVB. But they've been working through this for a while now. They had a big influx from Saudi National Bank. They've capped what they're going to do. So now it's really, I just noticed this was Swiss National Bank that came in and helped this today. So this is going to now be a Swiss finance/government rescue or assistance. But I don't think they're going to let this thing fail. So I'm not real worried about it. National pride.
All right, so we've got a question from Zoom. So John, you can take this one first, and then we'll go to Jeffrey. So once inflation stabilizes at 3% or less, where will interest rates be in the long term?
That's an absolutely great question. I'm glad that they asked that question. Normally, if Jeff is right, and I'm not gonna, this is gonna be see, I had this problem. We've been here now for 45 minutes, and the two economists have been agreeing.
I know.
That in and of itself is an issue. So on the other hand, Okay, I'm not sure I'm 100% behind Jeff at 3% by the end of the year. I hope he's right, but I'm not 100% sure. But when and if we get to that 3%, that's a great question about what interest rates would be. And I will simply say this, the problem we have had over the past decade plus since we came out of the Great Recession has been that we've had essentially free money. We've had negative interest rates. Just a personal note, I picked up a car a year and a half ago off of lease. Okay, the car price was, 15, 20% above the lease buyout number, and the bank gave me 1.8% 5-year financing. I'm like, what's wrong with this picture, right? I had no choice but to buy the car. And but my point is, we've had this essentially free money period for so long. What I'm hoping, to answer the question, is that we will actually still have positive interest rates, so that if you, in a 3% inflationary environment, you're going to borrow money, you're going to pay 5% for it. You're going to have a real interest rate. There's going to be a real opportunity cost associated with it. We're not going to go back to what we had for the last dozen years, which is essentially free money.
Jeffrey, you agree?
Yeah, well, a positive real interest rate. You're thinking about, inflation rate and then the nominal for Fed funds being slightly above that. So, maybe even a 4.5, to 4, something that would allow for, growth as the economy ages, right? Productivity slows. Perhaps growth doesn't, long-term growth is not as hot as it was in the last decade or two. So thinking about a 4.5 Fed funds, I think, is very defendable.
Okay, great. So let's do another in-person question. All right, here we go.
John, John and Jeffrey and Jennifer, thank you for being here. Continuing along the lines of things that don't make sense, free money. What's part history and part gut tell you about when this $30 trillion worth of debt is going to come home to roost, and what is that going to look like?
Okay, so we've got a big issue. I'll take this because,
Yeah, when
it's
and
a former
what's it
student
look
of
like?
mine.
On the back row as usual.
I remember it well. A few years ago. Anyway, it's an interesting question, because we're all aware that we're running up against a debt limit, a hard debt limit. At some point, maybe December, maybe sooner, because if the Fed has to spend a lot of money, if FDIC spends more than what's in their and start moving money out of the Treasury, it could come sooner than June or July. It may come in May. But we're up against a debt ceiling. The question is, okay, right now we're running about 130% of GDP for our accumulated debt. And the question I think Dennis is asking is, how long can this go on? Can we continue to go to 135, 140? Here's what I'll tell you. There's not a lot of countries that are above us in terms of debt to GDP ratio that are doing real well, with one exception. Anybody know what that exception is? Japan. Japan's over 200%. And as far as last time I checked, the economy there works pretty darn well. So do we know where that limit is, Dennis? And the answer is, we know it could be a problem, but we don't know where that number is. And I know I didn't help you. You wanted me to be a real hard debt hawk, but I'm sorry. We don't know where that number is.
What's the reconciliation of that look like? I know what it would look like in my household. And again, with that, one difference between governments and individuals is, we have a finite lifespan. And we should be going out at about the same pace level that we came in. So we should be running our debt down. With government, it lasts forever. Jeff?
Yeah, you can amortize it to infinity. You could say, I think in terms of a leading indicator, think about global demand for our debt. Watch that. I think it's a great question, and I think it is fair to say, well, we don't know, but we know certain variables that'll give us warning signs when we know we're close to that level. And I think obviously the currency markets and then global debt markets. And of course, you think about where we sit in the global sphere. There's still so much of trade done in our currency, and there's still such a large holdings of our debt. And in essence, that gives us a little bit of, I guess, buys us some more time.
Yeah. And just one more thing I wanted to add on that. I mean, one problem that we could have, and I haven't looked at this number in probably 4 or 5 years, but at one point in time, the Treasury bonds and bills tend to, on average, roll over about every 6 years. And so as the interest rates start to rise, carrying that debt becomes much more of a problem. So yeah, we got a lot of debt we bought at 1% and 2% a few years ago, but essentially that starts to come due and we have to roll it over at much higher rates. And so the carrying cost or the interest on the debt starts to become a budget issue in and of itself.
Yeah, so the weighted average duration is close to that 5.5 years. Mm-hmm. You think about, okay, in 2028, what are interest rates going to look like?
Yeah.
That's your answer to your question.
Yeah, great. Thank you. One more question from Zoom. So the war in Ukraine. So, how much could an elongated war in Ukraine impact your forecasts? We'll start with John.
Oh, we'll start with me.
Yeah.
Would you
prefer I start with Jeff? We can start with Jeffrey.
Yeah, well, no, okay, I'll take it. All right, so this has been going on for a year now. It is a drag on both the U.S. and the European economy, so there's no doubt about it. It's a much bigger drag on Eastern Europe and the security there. Without getting into the politics of it, I don't see this thing ending this year. The good news is there may be a change because not a lot of fighting goes on in the Ukraine during winter. It's a little muddy, and probably we'll start to see some increased activity, and there may be a change in this standoff come April, May, depending on how effective the new weaponry we've been providing the Ukrainians. But yeah, this thing could go on for quite some time. In terms of its effect on us economically, it's not it seems like a big number because we're talking $1 billion, but remember what Everett Dirksen said, the great senator from Illinois from years ago. He used to say, "There's $1 billion here and $1 billion there, and pretty soon you're talking real money."
Now it's got to be trillion.
Yeah,
a trillion here, a trillion. Yeah, the only thing I would add is, I think when you look at commodity markets, particularly oil, the markets are more concerned about the risks in the banking sector now than Ukraine, and I think that, that's what markets care about.
So a question from the audience. Here we go. Oh, here we go.
Don't run.
We talked a few minutes ago a little bit about shelter cost, and you talked about owner equivalent rents and such. But shelter cost is really a lagging indicator. My question is, what do you think the chances are that with continued rate hikes with the Fed, that once shelter cost, which is over 40% of core CPI, actually catches up, that there's an overcorrection by summer?
Yeah, exactly, and that's certainly the risk that they're aware of, that there's an over-tightening. So you're exactly right. I put out a dashboard for our clients regularly of all the metrics of inflation and price pressures in the economy, and you can actually color code it, and you can see right off the bat, this is becoming more and more green, good, and here's kind of the lagged effects of rents. So we know that, market participants know that, policymakers know that, and so I think there's a lot of emphasis on the actual industry data, so apartment list, some of those industry trackers that actually are already telling us that across the nation new leases are down. So I think that clearly is a risk of over-tightening, but I don't think that that's going to happen.
Yeah. I'll just add to that, I'm also concerned about the multifamily industry, and not so much over-tightening versus overbuilding. And what that could do later in this year. Right now it's not a problem, but later in the year it could become a problem. And now all of a sudden, instead of saying you've got a mismatch between your deposit term and your assets, okay, in the case of SVB, between their depositors and the bonds they bought, you've got a term mismatch there. Now we've got actually some bad loans, which Silicon Valley didn't have, but banks could be looking at in the second half of this year. should we have some of these projects go belly up.
All right, we're going to take our last question here.
What is your opinion on what should a wise investor do or be looking for in terms of asset protection as well as investment accumulation?
Yeah, no,
Yeah.
that's a great question. I mean, I am an economist for LPL Financial, so I can, certainly talk about that. I think, well, right off the bat, it's just a good reminder that each household's needs are unique. So again, I can talk big picture. I will say that there's value in having professional advice, helping you work through that. I'll leave it at that, right? Like I said about my experience on inflation, I moved from Silicon Valley in 2021 to Charlotte, North Carolina. My inflation rate is like negative 5,000, right? That's me. My personal experience is very different than people in this room. Hence the reason why I think personalized advice is important. But I will say I think the idea that you look at relative rankings. I think we favor U.S. exposure over internationals. Right? I think that's one thing. I think in terms of where we are in the business cycle, we still favor value over growth. We're starting to put a little more into preferreds. I think that's valuable in terms of the overall asset allocation. And then, again, kind of from a bond standpoint, I think 2023 is going to be a great opportunity that bonds can actually act like bonds again, right? It certainly wasn't the case last year. So I'll leave it at that.
Okay, I'd like to add just two things to that.
Sure.
Okay, thing number one, please do not go to the bank and take your money out. Okay, that's number one. You'll be doing it'll be a social good that you'll all be doing. But the second thing I think, and again, as Jeff said, everything is personal based on where you are in your life. But I think there's one thing for folks that are aging and starting to thinking about retirement. Typically, your advisors would provide you and suggest, well, you need to be a little less risky, a little bit more fixed income kind of stuff. But I think going forward, for those of us, I'm not implying anything, sir. I just, you look to be close to my age. Historically, we tend to be more fixed instruments. But I think going forward in the next 10 to 20 years, and because we're going to live longer, I think that we have to have a little bit riskier portfolios going forward. And I'm like Jeff. I agree with what he said. And I'm an economist, and I have a financial advisor that I paid to help me through this stuff. Okay, I want somebody that does this every single day for a living. Okay.
All right. So thank you, Dr. Connaughton. Thank you, Dr. Roach. This has been a fascinating conversation. So let's thank them, please.
And thank you for all of you attending. We really appreciate that.
Well, I was going to say that. Thank you for all of you attending. So please, excuse me, make plans to join us for the next forecast in May and the release of the second quarter report. So we look forward to seeing you on Zoom for that one. And help us as we plan future Belk College events and to be entered for a chance to win a Belk College gift pack. Please complete the brief online survey by scanning the QR code. So this concludes our program today. We look forward to seeing all of you in May.